Ladies and gentlemen, good day and welcome to Vedanta Limited's fourth quarter financial year 24-25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. Participants connected on webcast link may change the quality settings to 1080p to watch the proceedings on best quality. I now hand the conference over to Mr. Charanjit Singh, Group Head Investor Relations, Vedanta. Thank you and over to you.
Thank you, Operator. Good evening, everyone, and welcome to Vedanta Limited Q4 and full year financial year 25 earnings call. On behalf of Team Vedanta, I thank you all for joining us today. I hope you had the chance to look at our press release, earnings presentation, and detailed financial statements uploaded on the website of stock exchanges and also on the company website. On this call from Vedanta side, we have with us our newly appointed Group CEO, Ms. Deshni Naidu, a seasoned leader in the metal and mining space with over 27 years of global experience. This appointment marked the homecoming for Ms. Naidu, who was previously with Vedanta from 2014 to 2020 and leading the base metal and Vedanta Zinc International business as the CEO. We also have on the call Mr. Arun Mishra, our Executive Director, Mr. Ajay Goyal, Group CFO, Mr. Sunil Gupta, Chief Operating Officer, Aluminium Business, Mr. Anup Agarwal, CFO, Aluminium Business, Mr. Hitesh Vad, CFO, Oil and Gas Business, and Mr. Chris Griffith, CEO, Vedanta Base Metals. We will begin with the opening remarks from Ms. Naidu, followed by an update on the company's operational performance by Mr. Arun Mishra and financial highlights by Mr. Ajay Goyal, and thereafter we will open the lines for Q&A. This call is covered by the cautionary statement on slide 44 of the results presentation. With this, I now hand over the call to Ms. Naidu. Over to you, Deshni.
Good evening, everyone. Thank you, Charanjit. It's a pleasure to address you all as the newly appointed Group CEO. Returning to Vedanta feels like coming home, and I'm excited to lead us into our next era of growth and transformation. Over the last 25 years, Vedanta has grown into India's foremost natural resources conglomerate. Under the visionary leadership of our chairman, Mr. Anil Agarwal, we are entering an exciting chapter we call Vedanta 2.0. The goal is clear: to transform the company into a $100 billion critical minerals energy technology powerhouse, serving not just India, but the world. This vision is rooted in creating long-term value for our shareholders, the communities we operate in, and the planet we all share. Looking at the broader economic landscape, FY25 was a good year for commodities. Global primary aluminium demand grew by 2.7% and zinc demand saw a 2% increase. In India, primary aluminium demand increased by 12% year on year and zinc around 6%. That's a 4% and a 3% increase over and above global growth, respectively, driven by robust domestic economic expansion and infrastructure development. Now, FY26 has started on a relatively volatile note, with the global economy facing uncertainty due to the announced U.S. tariffs and the retaliatory tariffs we have since seen. However, we are well positioned to weather these uncertain times. With over 50% of our aluminium production and around 75% of our zinc production sales in India, Vedanta's performance is strongly integrated with India's growth story. Economists are forecasting India's GDP to grow by over 6% in FY26, and that's despite the tariff impact. Our margin improvement story remains largely intact. While the LME prices of the commodities such as zinc and aluminium are lower compared to their annual average levels of FY25, input costs have also seen a material decline. For example, aluminium prices have declined by approximately $300 per ton from their peak of $2,700 per ton just in March 2025, while alumina prices have dropped by around $450 per ton from their peak of $800 per ton in December 2024. We are all set to benefit from our enhanced asset base given the commissioning of our second 1.5 million tons per annum train at Lanjigar, our 435,000 ton smelter at Balco, and the new value-added product capacity that we are bringing on in FY26 in aluminium. The benefits of our backward integration efforts will be realized during the year with the commissioning of our bauxite mine and new coal mine. We see the incremental value creation from our new assets offsetting any downside that the weakening in broader macroeconomic terms may pose for Vedanta. So we are well positioned. ESG principles are integral to our strategy. Safety is a core value for us in the company. We are dedicated to learning from our safety incidents and are committed to our zero fatality goal. Every leader at Vedanta is expected to challenge unsafe practices and uphold our safety standards, ensuring that our workforce returns home safely every day. In FY25, we secured power delivery agreements of over 1 gigawatt of renewable energy, and we will enable significant reduction in emissions from our operations in the coming years. We are proud to have directly benefited 26 million women and children and empowered 1.46 million families through skills training. Our efforts have been validated by third-party agencies. Vedanta Aluminium ranked second, while Hindustan Zinc secured first place in their respective peer groups in the S&P Global Corporate Sustainability Assessment. We are making good progress with our demerger plan, aiming to create pure-play entities that will enhance strategic focus and operational flexibility. In FY25, we delivered our highest annual revenue of 150,725 rupees crore and its second highest EBITDA of 43,542 rupees crore. We also made progress on our $9.5 billion capital expenditure program, with $5.5 billion already spent, including $1.5 billion in FY25. The remaining $4 billion will be invested within the next 3 years, supporting our strategic projects on volume expansion and backward integration. So in conclusion, Vedanta 2.0 is about our new vision for growth, governance, and stakeholder interest. We are transforming the company into a global leader in critical minerals, energy, and technology, and ensuring long-term value creation for all stakeholders. This exciting transformation will redefine Vedanta's position on the global stage and position us as a key player in the industries of the future. Thank you. I now hand over to Arun.
Thank you, Deshni. Good evening, everyone. As we initiate our journey on Vedanta 2.0, it gives me immense pleasure to share with you the performance of the year that has gone by and reflect upon some of the key milestones that demonstrate the strong foundations on which the Vedanta Group stands today. I am happy to share that Vedanta has delivered the highest annual revenue in its history of rupees 150,725 crores, up 10% year-on-year. We also reported our second highest EBITDA of rupees 43,541 crore, up 37% year-on-year, reflecting strong operational performance. I am pleased to highlight that our key businesses, aluminium and zinc, have continued to maintain their cost leadership positions on the global cost curves, reinforcing our competitive strength in the industry despite the volatility of global commodity markets. Now let me share some individual business-specific insights, starting with the aluminium business. The aluminium business has achieved its highest ever annual metal production of 2,422 kt, thereby surpassing our volume guidance for FY25. In Q4, the business delivered an all-time high quarterly volume of value-added production of 338 kt, implying 16% year-on-year growth, which has translated into best ever net effective premium of around $300 per ton. On the cost side, the business achieved hot metal production cost, excluding alumina, at $920 per ton, which is the lowest in last 4 years. Our total cost of production, inclusive of alumina, saw an increase due to the carry forward of a high-cost alumina inventory from the previous quarter. The benefit of softening of the global alumina prices will be reflected in the cost of production numbers of Q1 and Q2 of FY26. The EBITDA margin per ton of our aluminum business in Q4 jumped 47% year-on-year to $880 per ton. Moving to Zinc India, we achieved 310,000 tons of mined metal production and 270,000 tons of refined metal production in Q4, which enabled us to deliver highest ever annual mined metal production of 1.095 million tons and refined metal production of 1.052 million tons this year. The production cost of the quarter stood at $994 per ton, which is 5% year-on-year improvement. We surpassed 13.1 million ton of available metal reserves for the first time since underground transition. In our Zinc International business, overall volume increased 52% year-on-year and 9% quarter-on-quarter to 50,000 ton. Our Ramsburg mines delivered a strong 89% year-on-year and 15% quarter-on-quarter increase in MIC production of 41,000 tons. We are currently producing at a monthly run rate of 18,000 tons. With continued improvement in mining performance and ore availability, we are confident to achieve our production guidance of 235 to 265,000 tons. On the cost side, we achieved our guidance of $1,300 per ton on full year basis, driven by higher and efficient production and lower TCRC. Talking about oil and gas business, Q4 production stood at 96.2 kbpd, impacted by natural decline in MBA field and offshore blocks. We drilled 10 infill wells across the Saraswati and Aishwarya fields in Q4 FY25, thereby taking the total count of infill wells to 28. I am pleased to note that Cairn managed to acquire 7 of the 28 blocks in the latest round of OALP auctions, taking our total portfolio to 63 blocks spanning 73,000 square kilometers. On iron ore business has seen a strong increase in quarterly production, rising 24% year-on-year and 40% quarter-on-quarter, driven by steady ramp-up of bitumen mine operation in Goa. Now let me provide an update on our key growth projects. Starting with aluminium, we are on track to commissioning the Lanjigarh Refinery Train 2 with the first metal production from the train targeted in the current quarter. The Balco smelter expansion of 435,000 tons per annum is an advanced stage and with the commissioning targeted in the first half of the current financial year. At Zinc India, our 160,000 tons per annum roaster at Debari will be commissioned in the current quarter and a 510,000 tons per annum fertilizer plant in Q4 of this current fiscal year. At Zinc International, our Phase 2 expansion project is targeting commissioning in the second half of the current fiscal year. In our merchant power business, 300 megawatt of Meenakshi power plant is now commissioned. The remaining 700 megawatt capacity is targeted for commissioning in the first half of this current fiscal year. The Unit 1 of Ethana power plant is also scheduled for commissioning in first half of this fiscal year, while the Unit 2 is expected to start operation in March 26. Speaking about our ESL facility, we are expecting total hot metal capacity to increase from 1.7 million ton to 3.2 million ton per annum by FY26 end, with plans to further debottlenecking to 3.5 million tons per annum in FY27. In conclusion, we have delivered an outstanding Q4 performance and ended the year on a high note, where we not only delivered the highest ever annual volumes for aluminium and zinc, but also drove down the cost of production significantly, reaching a 4-year low cost in Zinc India and ex-alumina cost of production at our aluminium business. Looking ahead, we believe that FY26 holds tremendous potential for Vedanta. The completion of key growth and integration projects will continue to drive our volumes and margins. We are confident of continuing to create long-term value for all our stakeholders. I will now hand over to Ajay for an update on financial performance.
Thank you, Arun, and good evening, everyone. I'm pleased to share that this year we have achieved a significant milestone with our highest ever annual revenue crossing rupees 1.5 lakh crores. In addition, we have also delivered our second highest EBITDA of rupees 43,541 crores, driven by structural changes in operations and strategic initiatives with a strong domestic demand. This performance is further supplemented by key corporate actions that have significant strengthened our balance sheet and capital structure positioning. Coming to fourth quarter FY25, I'm pleased to share that we have delivered our highest ever quarterly revenue of 39,789 crores, up 14% YOY. EBITDA reached 11,618 crores, reflecting an impressive 30% growth YOY. EBITDA margin increased to 35%, which is highest in last 12 quarters, representing a surge of 465 basis points YOY. PAT of rupees 4,961 crores, marking an exceptional growth of 118% YOY. Now coming to highlights for the full year. Annual revenue is up 10% YOY and EBITDA is up 37% YOY with EBITDA margin of 34%. This YOY comparison focuses on core performance and excludes one-time gain from Kane arbitration that we recorded last year. Our PAT for the full fiscal stands at rupees 20,535 crores, marking a remarkable increase of 172% growth YOY. And finally, ROC at about 27% with a 371 basis point improvement YOY. Turning to our balance sheet, and as on March 2025, our net debt stands at 53,251 crores, which represents a decrease of more than rupees 3,000 crores YOY. This reduction is primarily attributable to cash from operations. At the same time, various actions that took last year, for example, the QIP or offer for sale for zinc shares, which has been partly offset by capex, growth and sustaining, at the same time rewarding our shareholders through dividend. Additionally, we also maintained our maturity of debt, which is more than 3 years. This quarter also witnessed significant improvement in our net debt to EBITDA ratio, which has improved to 1.2x as compared to 1.5x in FY24, reflecting effective debt management and much more strengthened financial position. And finally, we ended the year with a strong liquidity position of 20,602 crores, representing a 34% increase YOY. On demerger, I would like to share that following a favorable voting from shareholders and the creditors in the meeting held on 18th of Feb 2025, we have moved to second motion petition before NCLT, seeking tribunal's approval to proceed on demerger. We anticipate completing the demerger by September 2025. Quickly, in terms of corporate actions and deleveraging, Vedanta, you may have noted, last year has firmly established itself as one of the most proactive companies in terms of executing strategic corporate actions. This year, we witnessed a number of such actions, including 8.5 thousand crores via QIP, rupees 3,150 crores via offers for zinc shares, $500 million through equity partnership at our parent company, Vedanta Resources, and also refinancing 3.1 billion bond portfolio for parent company at lower cost, longer maturities, and much congenial terms and conditions. All these actions have supported us in achieving a deleveraging of 1.2 billion at group level, out of which 0.7 billion at the parent company, VRL, and $500 million at Vedanta India, VDL. As a result, the debt of our parent company, VRL, has decreased to 5 billion, which is the lowest in a decade, and the leverage at group level has improved to 2x from 2.7x a year ago. With this progress, both Vedanta Limited and its parent entity now maintains a strong level position than most of our key global peers. Furthermore, the credit rating has also seen substantial improvement last year. Both CRISIL and ICRA has augmented the VDL rating to AA from AA-, and VRL, our parent company, has seen an impressive 3-notch improvement, reaching B+ from CCC+ by S&P. In conclusion, FY25 has been a landmark year for Vedanta, driven by operational excellence, disciplined capital management, and timely strategic initiatives. These actions yielded returns for shareholders and established Vedanta as a major wealth creator in India for FY25. As we usher into FY26, we do so with renewed energy and strategic clarity. Our focus will remain sharp on scaling up volumes, unlocking further cost opportunities, fast-tracking high-impact growth projects, and executing the demerger to unlock long-term value. And with these changes, Vedanta 2.0 is not just a new chapter. It is a fundamentally transformed enterprise. Thank you. And now I will hand over to moderator for any Q&As.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Ashish Kejriwal from Nuvama Wealth Management. Please go ahead.
Yeah, hi, good evening, everyone. Thanks for the opportunity and many congratulations for good set of numbers on this. Sir, I have a couple of questions to start with our alumina. So we have been consistently getting somewhat delayed in our ramp up of alumina plant, though we have capacity of 3.5, but we were running at 2 million tons. So my question was, is this based or the guidance which we have given for 3.1 million ton for FY26, is this based on Sigimilli mine coming in, or without that also can we do that, and when can we see this run rate? That's my first question.
Thank you, Ashish. It's Deshni. Ashish, I'll start and then I'll hand over to Sunil to complement. So firstly, Ashish, to your point, the first 1.5 million ton train is actually in production, but of course it does take time to ramp up. So current production is in play, and that's just under 2 million, 1.8 to 2 million tons, and our first 1.5 is in train. If I look at this past year's performance as a site, we delivered 1.9 million tons of total production. In terms of your question, and I'll put it into 2 parts, the overall ramp up is going to be 5 million tons, but at the end of this fiscal year for us, we intend to be at an exit run rate of close to 4, and the total production for the year will be just over 3 million tons. That's taking into account our ramp up plans. In terms of the 5 million tons by FY27, we hope to be close to those numbers, but to show you the confidence in the process that the team has, we've already started to commission Train 2, and we've actually started to have our first metal pump, Calcine 4, this past month. Now, you asked us about bauxite and how that is linked to what's happening in the ramp up of the plant. I'm going to hand over to Sunil, but I can tell you that we are working on many plans. Firstly, it includes, what do we do with integrated production, but Sunil and the team has a plan B as well. So Sunil, over to you.
So thanks a lot, Deshni, and thanks, Mr. Kejriwal, for this question. So what Deshni has just now said, that we are ready for the Lanjigarh refinery, and this year we are planning to have the production of 3.1 million ton of production from Lanjigarh, and for that we have the sufficient bauxite. your question that CGMLE, whether CGMLE will come and it will not affect our production. We are ready with the CGMLE. We are hopeful that the quarter 3 we are going to start the CGMLE mines. And even if we slip in the CGMLE also, we have the alternate plan to cover up. So I am assuring that for want of bauxite, we are not going to lose any alumina production, because we have several other domestic sources also, and we have other imported places. Imported bauxite is also available from different sources which we have identified. So for want of bauxite, the alumina production is not going to stop. Even in this case,
Thank you, sir. But again, we have been repeatedly talking about that. We have the capability to produce, but because of one or the other reason, we are not able to produce in last one half. So out of 3.5 million ton, we still are running at 2 million ton run rate. So I don't know, if CGMLE mine does not come in, from where we can source bauxite and run the plant at 3 million ton run rate. So when can we see this run rate, sir?
So 3.3 million run rate is now we are going to in the May month itself, we are going to touch the 2.6, 2.7 million, and 3 million by June, and we are going to touch the 3 million run rate.
Maybe Ashish,
so in second quarter, definitely we can see 3 million run rate.
Yeah.
Sorry, ma'am. Yes,
maybe to simplify it, we need 9 million tons of bauxite for a 3 million ton in terms of run rate, right, for this year. And what Sunil's just summarized, we have sources for all of that. CGMLE mine development continues, and for the year, we are looking at just over 1 million tons, assuming all the plans go, or everything goes according to plan, and we start producing by August this year. So, and the point I want to make is, even when CGMLE comes online this year, we're still going to need other sources of bauxite.
Thank you. That's helpful. Second question is on our demerger only, because what we understand is that we need to transfer mining lease also to different companies, and then only we can have our demerger complete. Because remember in 2010-11 when CESA Goa and Sterlite was there, we need to reverse merge with CESA because mining transfer was an issue. Now here we are seeing that CGMLE mine, bauxite mine, as well as coal mines, that's under Vedanta Ltd level. And now we have to transfer it to Vedanta Aluminum. So do you think that, first we have to transfer it or sign the mining lease under Vedanta Ltd, and then we have to transfer to Vedanta Aluminum, and after that only we can complete our demerger plan, or am I missing something?
Ashish, you are right. This is part of the overall approvals that we have in our site. So, of course, the process that's happening right now in NCLT is to approve the overall scheme, but the team has a detailed approvals plan, including all of the mining licenses that will start being approved. In fact, have already started the process. We are still confident with all of the processes that are happening in parallel to complete the process by September 25.
And lastly, we have been committing that we are going to reduce Vedanta Resources debt by around $3 billion. And out of that $2 billion, we have already paid. That's very commendable. Going forward, if I look at the repayment schedule, it seems that next 4 years, we have to repay something like $2 billion. So my question is whether this entire debt we are going to repay or part of it we are going to refinance also, because for next 4 years, we have a repayment schedule of just $2 billion. And in that question only, I hope that brand fee is still 3% of standalone revenue, and which is continuing till when?
Yeah, that's correct, Ashish. Thank you. So you're right. You have witnessed over the last couple of years the entire path of deleveraging at Vedanta Resources. At the same time, the entire 3.1 billion worth of bonds getting refinanced. It also flattens the maturity curve. And in the last bond refinancing, the maturity is as long as more than 8 years. That means less cash requirement at Vedanta Resources. Now let us look at FY26, the ongoing fiscal year. The total loan maturities is about 920 million. And if you also add the interest cost, $500 million or 550, Total cash requirement at Vedanta Resources in the current year is about 1.4 to 1.5 billion. This number used to be almost double in the years just gone by. Now, against 1.5 billion of the cash requirement, what are the sources? So brand fee, you're right, it remains 3%. That number is almost 400 million in the current year, which has already been paid contractually as we do in the first month for the fiscal. The second source of cash is dividend. Even if we pay a normalized dividend with about 6% yield, that amount will be almost 800 million receipt at Vedanta Resources. So 400 brand fee, 0.8 billion is a dividend, is 1.2. And that leaves only a small delta of almost 270 odd million. That always can be refinanced. So overall, by paying almost half the dividend than the recent average, we can deleverage Vedanta Resources by 600 million the current fiscal. So our overall target of reaching to 3 billion debt in 2 years remains intact. It will be mostly through operating free cash flows, at the same time without leveraging Vedanta India.
Yeah, thanks, Ajay. My only question was because for next 4 years, our repayment schedule suggests a $2 billion debt repayment only. So we don't need to refi actually, or, if we refi only for lower interest cost, then that's a different issue.
Yeah, Ashish, given that there's a big queue of people in waiting for asking questions, so
thank you so much.
Yeah, I'll take it offline with you after this call.
Sure.
Thank you.
Sure. Thank you and all that.
We'll take our next question from the line of Amit Lahoti from MK. Please go ahead.
Thanks for the opportunity. Given that bauxite and alumina prices have come down significantly, how do we think about the benefit in terms of cost of production in FY26 from the current cost of $2,000 per ton? I've seen the guidance, but if you can basically walk me down to how do we reach there? So that's my first question.
Thank you, Amit. I'm going to hand over to Anup.
Thank you, Deshni. And Amit, to your question, Q4 we did a cost of $2,000, and if you see, alumina was somewhere around closer to $1,100. This is already covered and also mentioned by Sunilji that given that we are targeting Lanjigarh at 3 million ton annual production, and in the first quarter itself, we are looking at doing around 55% of our alumina requirement from our captive sources. So this is one, and the second, with the imported prices coming down from the levels that we saw closer to 800 to where we are now 400, 350, you will see that around $225 to $250 cost, we see optimization in Q1 itself. Now coming to the power cost, if you would have observed last few quarters, okay, we have done substantial improvement, both in terms of coal prices, coal materialization, logistics, in terms of the improving the rate coefficient and improving our power plant PLF. So we expect another $40-45 coming from the power cost. We are seeing a small headwind in terms of carbon, but net we see very clearly the cost coming down closer to maybe the guidance that we've given, maybe embed the upper side even in Q1. Samit, hopefully I have answered your question.
Yes, sure. Thank you. And my second question is on the updated timelines of Sijimali and coal mines commissioning. So I sense that there has been some delay in Sijimali because in the last quarter it was supposed to be commissioned in Q2 of FY26 and now it seems to have moved to Q3. So that is one. And then if you can outline the coal mine commissioning timeline.
So I think for the Sijimali mines, we have already completed the land acquisition. 97% land acquisition is there. We are almost on the last leg of the forest clearance first one. And if you ask me the EC already we have preponed the EC. We are targeting that we are going to get the EC in the June 2025. So we are hopeful that we are going to commence the operation of Sijimali mines by Q2 FY26. This is what for the Sijimali mines. Coming to the coal mines, the Kudloi mines, which we have said in the Q3 FY26, we are going to commence the operation. And for our Bhogarpally coal mines, we are expected that we are going to commence the operation from last quarter of the FY26.
Thank you, Sunil. And Amit, just to confirm, the Sijimali timeline is still the timeline that we committed to in the previous reporting period of first ore, the second quarter FY26, and full ramp up by the fourth quarter FY26. So no changes.
Thank you. We'll take our next question from the line of Aditya Virekar from Axis Securities. Please go ahead.
Yeah, thanks for the opportunity. I just want to know what is the sourcing mix for bauxite and alumina in terms of captive and third party, and once the Sijimali mine comes online, how that mix will change?
Anup?
Yeah, Anup, I think this is an extension of the previous question. Anup.
Thank you, Desli. And Aditya, see, alumina I have already covered. In quarter one, we are seeing 55% of the alumina coming from our captive source with the balance imported. And as we ramp up, you will see that as we go into the quarter four and we reach production capacity closer to 4 million ton, 65% of it will be the captive and the balance will be imported. Now coming to bauxite. See, bauxite you can divide it into two parts. One, the H1 when we don't have Sijimali, and then the H2. So 60% of the bauxite we have secured through domestic sources, ONC and other domestic sources. And the balance in H1 is primarily imported, and in H2 it will be domestic sources and Sijimali. Aditya, hopefully I have answered your question.
Okay, yeah, thanks for that. The second is on the conversion cost in this quarter, we can see on a sequential basis, the conversion cost for aluminium has dropped sharply. So in the previous quarter, it was $107 per ton, which has come down to $49 this quarter. And this looks structural in nature. So is it sustainable going forward?
So Aditya, you're right in picking up this. Out of this, $40 is a one-time cost, which is due to recovery of some old dues and write back. So that is not structural. Balance, yes, it's a structural, maybe $10-15.
Okay,
Aditya,
understood. Thank you. That's it from my side.
Thank you. We'll take our next question from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, thank you for the opportunity. My first question is on hedging. What are our current hedging positions that we have across minerals?
Sure, Indrajit. I mean, over the last couple of years, we have been actively tracking and participating in the hedging program. And even in the current year, when the pricing has been a bit of volatile as the year began, this area is under active consideration. So our hedging position for the current fiscal is mostly in aluminum. So almost our annual volumes, 12%, almost 275 KT has been already hedged. And the hedging rate is $2,655 per ton. Secondly, in case of zinc international, a small quantity, 50 KT is already hedged. It's almost $28, $40 per ton. But in summary, we are watching this area very closely, and we will take the positions as market moves.
Sure. Thanks for that. This is helpful. Also, if you recall, in last year's Investor Day, you had highlighted two EBITDA targets, $6 billion for 25 and $7.5 billion for 27. While we have fallen short of FY25, despite commodity prices being resilient or robust, how confident are we of the 27 target of $7.5 billion?
Last year, we guided, historically, our guidance has been in the G around volume, cost, and capexes. And EBITDA guidance during our conversation was about $6 billion. So against $6 billion, it was at the group level. So we are at about 5.5. So there is some gap, but not miles apart. In the current year, if you look at one page in the IR document, it talks about guidance again on the volume, cost, and capexes. We aren't guiding for now for EBITDA, and as pricing stabilizes, we may guide on EBITDA as well. But important thing to note, if you look at the guidance, the volume at the midpoint of the guidance is about 10% growth versus last year. Cost again from the midpoint is about again 9%, and 1.5% is NEP. Net in FY26, we are foreseeing 20% growth led by operations, which is volume, cost, and NEP. Now, even with the current pricing, current spot, our EBITDA with these numbers will be far bigger than the last year. And as I mentioned, as pricing stabilizes, if you see 10th or 11th of April, post-tariff, the pricing, and right now, pricing across zinc, aluminium, and the Brent has recovered by 5%. So one should look at the growth led by volume, cost, and NEP. Pricing, we have to wait and watch.
I think, Indrajit, just to add to that, on aluminium, as we've just been discussing, we would have been shy of our cost numbers because of the spike in alumina prices that we saw globally last year, and that contributed to not meeting the internal or the EBITDA number. Similarly, on Hindustan Zinc, slightly shy of the metal that we would have liked to produce, despite the good efforts that Arun and the team have made in terms of their mining tons. And Zinc International, I think when Chris talks, it's good to see where we ended the year, but we did fall short of our targets in terms of production in the first half because we chose to catch up on our mining tons. So those were, I would say, the levers that Ajay just spoke about. Those were the reasons why, we were slightly shy of our of hitting our EBITDA numbers against the improved LME profiles.
Thank you. And lastly, how is Concall copper mine ramping up, and any plans of getting it into or moving it to India entity yet?
Thank you for that. I'm going to hand over to Chris to talk about our very exciting copper growth story in Zambia. Chris.
Hi, Deshni. Thanks very much, and thanks for the question. Yeah, so I think we're making very good progress in the ramp-up of KCM. Remember, we only got the mine back in August, started production in September, and we've ramped up KCM to about 45,000 tons of integrated copper, of which about just under 30 was from our own production, and 17 from the custom production. So we're ramping up very nicely. I think this year, and we will give some updated guidance, I guess, Deshni, in the next call. But previously, we said when we gave market guidance in October, we said that we'll do about 150,000 tons of copper in 2026. I'm very pleased to say that we're on track to deliver that and probably a bit more. So as I said, we'll probably give you more updated guidance, but the ramp up of KCM is going really well. We'll be above the 150,000 tons, probably closer to sort of 170, 180, but that's not the guidance for now, but just to let you know what that ramp up's looking like. So overall, on this amazing KCM assets, this year we'll see a ramp up. We'll be cash positive this year, starting to make money, investing in the business, starting to invest in the new capital to complete the KDMP project to ramp up to 300,000 tons. So, I think overall this great asset is ramping up nicely now that we've got the assets completely back in our own hands. And the investment that we've committed to the government of Zambia of $1 billion over 5 years is very much on track, and we'll probably invest just over $300 million for this financial year, both in some fixed and some growth, but also in the major completion project of KDMP. Yeah, so overall going quite nicely in the ramp up.
The second part of the question was regarding any plans of bringing KCM to India entity. So right now, as Chris mentioned, our focus, rightfully so, remains in operationalization and augmenting the volume at KCM. And in terms of any restructuring, right now, not under active consideration. That may happen in fullness of time, not right now.
Thank you so much for your answers, Ajay. That's all from us.
Thank you. We'll take our next question from the line of Ritesh Shah from Investec. Please go ahead.
Yeah, hi. Thanks for the opportunity. A couple of questions. First one for Dashni. Was surprised to see basically copper smelter specific to Saudi Arabia not there on the capex sheet. Any specific reasons over here? And at the current TCRC, if we had to go ahead with the project, how would we look to justify the underlying economics?
Okay, I'll start and I'll hand over to Chris actually to support. So we have signed the MOU, and of course we're still in the study phase, looking at the options. Once we've concluded and have a final, feasibility study with us, that's when we'll actually indicate the capital amount. So maybe I'll hand over to Chris to talk about the progress of the study. Chris.
Yeah, thanks, Dashni, and thanks, Ritesh, for the question. Yeah, look, I think Dashni was correct in saying, look, we've signed the MOU, so it's still very, very early days. We have done a high-level feasibility study that we're in discussions with the government of Saudi, and there's a whole range of enablers that are part of the package of investing in Saudi, and it's currently those enablers that we're discussing. So, what long-term loans, what grants, what other duty protections, and the like. So there's a whole package of enablers that we're currently in discussions with the government of Saudi. And depending on how those go will depend on sort of how the project may progress or not. So I think just very early days, signed the MOU, project looks interesting, Saudi looks very interesting, the government are very supportive and are trying to attract all this investment to Saudi. And it's on the basis of those enablers that we in discussions with governments at the moment. But I guess it's still very early days and still some I guess large yards will have to be covered before we can commit to any capital for that project. Thanks.
And maybe Ritesh, just to add, Ritesh, just to add, we would have put a little bit of study money into the growth capital category under others, and that's in our guidance of about $1.5 to $1.7 billion. So there is some money in there under others pertaining to study costs.
Sure. Thank you. My second question is for Ajay. Sir, you indicated $600 million of reduction in leverage at BRL. I understood the bridge of 1 point is the ask, and then basically you explained 400, 800, which was royalty and dividends, leaving the balance 270. So I was not able to reconcile the $600 million number, sir.
Okay. So if you look at the source of cash at Vedanta Resources, I say the brand fee is 400, and dividend, if we assume 6% yield, which is less than half of the recent past, so it is 800. So 400 plus 800 is 1.2. Against 1.2, the interest cost is 550. And if you also add, say, 50 million for other expenses, 600. So 600 is expenses, 1.2 is source of cash. That means deleveraging of 0.6 billion in current year.
So I couldn't comprehend still.
Maybe in that case, Ritesh, I'll talk to you maybe.
Ritesh, I'll take it offline with you after the call. Charanjit here.
Sure. And just last two questions, specifically on Meenakshi and Etna, possible to highlight what the coal sourcing is and if at all we have signed any PPAs for both the assets separately. And the last one was on bauxite. What is the rate at which we are procuring bauxite from OMC? I read the annual report, I find the rate of almost 1,000 rupees per ton, which looks too low. Is there anything amiss over here? If you could please clarify on that. Thank you.
So, Ritesh, I'll take the power and we'll let Anup take the bauxite query. See, we haven't signed any PPA as of now. For the first year, it'll be all merchant power, short-term contracts. So I think we will sign for both the SSA first, and then we will go for the PPA, more of a medium-term PPA. But if you look to the rates in the merchant power market today, you will get very good rates. So at least for 1 year, our model will be more like going for the merchant power contracts.
Sure. And bauxite costing specifically from OMC?
So, Ritesh, So to your question on the bauxite OMC, the cost that you mentioned, no, that's only the basic cost, and then the taxes, duties, and the logistic costs are all extra.
Right, but still 1,000 rupees is way too low, because if you look at the e-auction prices, the numbers are significantly higher. So I understand it will be X mine and everything else will be extra. So is there anything which is baked in contingent liability that we should be aware of? Or is this the pricing that we have, that Vedanta as a group has from OMC?
See, this is the price which is there today. Of course, there is a small litigation going around it, but this is the price which is there today.
Okay. So there's no risk of contingent liability over here, just a clarification.
Not as of now. There's nothing as of now.
Sure. Thank you so much for the answers. Thank you.
Thank you. We'll take our next question from the line of Pallav Agarwal from Antique Stock Broking. Please go ahead.
Yeah, good evening. So, a related question, on the alumina cost, because currently market prices, are around $350 per ton, and our cost of production at Lanjavir also seems to be either in that range or a little higher. So, once probably the captive bauxite starts, what sort of cost reduction are we looking, at compared to the current cost of production?
Thank you. I'm going to get Anup to answer that, because it's the extension of the same question, Anup.
So yes, so Lanjavir cost, if you would have seen in Q4, we did a cost of around $370. Now it is two factors. One, the bauxite sourcing. The bauxite that we're getting from the domestic source versus the imported source. So part of it is to do with that, and the part of it is to do with the volume. Going forward, as we ramp up our production in Q1, we expect this cost to be somewhere around $340-350. Now coming to your question on what the API or the imported bauxite cost, those are all the ex-works cost, the $350 or the $400 that we saw in the month of March and April, and then we have a $60-70 on top of it. So at this point of time also in Q1, we expect our cost to be $35 to $50 lower compared to even the API that we are seeing in the month of April.
This is the API landed cost, you're saying, comparing with that?
Landed cost, yes.
Sure. Other questions again on the Athena, power plant. So when you look at the capex slide, so there's still a significant amount of unspent capex over there. So how confident are we of, really starting that asset during this year and achieving the targeted PLF?
No, so don't equate between the capex spend and actual commissioning of the power plant. Athena first part is commissioned, and next 700 megawatt will be commissioned this year. So absolutely there is no concern on that ground.
So just to confirm, Athena Unit 1, 600 megawatts, it's being scheduled for commissioning right now, Q1. And the second unit is another 600 megawatts that's being scheduled for commissioning in Q4 of this financial year.
So any broad guidance on what type of profitability we can expect from that plant?
So can you repeat, please?
No, any broad guidance on what profitability we can expect from the Athena power plant?
So we are targeting roughly around rupees 2 a unit in terms of the EBITDA level. Our generation cost is likely to be closer to 3.5 rupees, which will be, let's say, 3 rupees for the variable cost of coal and 50 paise on the fixed side. And with respect to what we are likely to get in the merchant power market is minimum of 5.5 to 6 rupees. So if you look into the current prices in the merchant power market, for the contracts what we have for Meenakshi, we are in position to generate per unit more than 6.5 rupees at this moment. And for the deficit period, when the power picks up in the summer, we also have some contracts, though for a small quantity from Meenakshi, signed for 10 rupees a unit. So the current profitability in the merchant power market is very good, and also the reason that we, at least for 12 months, will take this route versus going for a long-term or medium-term PPA. Does that answer your question?
Yeah, thank you. Yeah, that's it from my side.
Thank you. We'll take our next question from the line of Amit Dixit from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. Congratulations for a good performance. A couple of questions from my side. The first one is essentially on value-added products in aluminium. Now, if I look at this year, it works to around 14%. Now, given our production is going to increase to roughly 3 million tons at the lower end of the guidance, what kind of value-added proportion in terms of percentage can we expect for FY26?
Yeah, I'm actually gonna. Yeah, Anup, please.
So, Amit, so this year, if you'll see, we have done closer to 50%. And next year, we expect it to be somewhere around 70% as we ramp up the balance facilities both at Balco and Jharsuguda.
Sorry, what did you say? 17 or 7?
Amit, 70%.
70%. So that means the premium that we have in this quarter, I mean, which is quite impressive at 301, that premium number should actually go up as we go ahead for aluminium.
Yes. So Amit, so there are two positives. One, as you rightly picked up, is on the value-added percentage. The second is on the domestic share, both of which we are seeing rise quarter on quarter. But there are some small headwinds also which we should keep in mind. Road tax on SEZ has gone away. While that's an advocacy topic and we're taking it up with the government, that's gone away. It takes away around $20. And this lower LME and some lower indices that we are seeing in the market, that takes away another $30. So net, if you look at FY25, we are seeing an increase of $25 to $30. It could have been more, but for the road tax and the lower LME oblique indices that I mentioned.
Okay. Got it. The second question is on oil and gas. So the guidance is 95 to 100 KUG PD. Now we closed the quarter at around 96. So are we expecting an uptick in oil production, possibly from whatever endeavors we have done over a period of time? And if so, from which quarter we can expect that? And also, if you could give an indication of OALP percentage in the total production in this year, FY26.
Thank you. Amit, I'm actually going to hand over to Hitesh. Hitesh, over to you.
Yeah. Hi, Amit. Amit, yes, you rightly pointed out, our current year number was around 104 and we have guided next year 195 to 100, while our Q4 number is at around 396. Now, the first part is, some of the things which we built during this year is primarily driven by some of the failures which we had in our Bangla wells. Those failures are now behind us, and that's why now, quarter on quarter at least, we are seeing a stable volume compared to what we had seen earlier during the first half of the financial year. Now, going forward, what will work for us? How do we assure to deliver our guided volumes for FY26? I think one of the key factors would be our ability to manage the declines, where we, as I said, last few quarters or a couple of quarters, we have done well. Second is, we have drilled quite a number of wells during the last 6-8 months. Those are being ramped up, progressively, which will add around, say, 7,000 to 8,000 of incremental volume for us. Additionally, we are still drilling wells, both in, gas field as well as the oil field, which we expect to add around 5,000 incrementally more. The third part, which is one of the biggest, driver for cane going forward on volume, is our ASP project. As we said earlier, we have commenced, injection in select pads. Now, for the larger cluster of pads, we are almost ready to inject. We will do the first injection in a larger cluster around July of 2025. And that, injection
would take around say 5 to 6 months to give us the volume upside, and we'll start seeing the impact of that injection. And of course, once we see the benefits, say around end of December, we would obviously extend the ASP project to all the clusters in Mangla, and then of course in Bhagyam and Aishwarya field as well. So these are some of the key things which we are doing as far as Rajasthan field is concerned, not only to contain decline but help it to grow, especially through drilling more wells and ASP project. In addition, during the second half of the year, we are also drilling infill wells both on the east coast and the west coast, given the weather window available after monsoon. During that time, what we'll also do is one of our DSF field, Ambe, which is offshore west coast, just near to our current producing Cambe field. So we'll drill 3 wells there as well, which will add volumes, but it will take around 18 months further down the year to come into play. It will add substantial volumes. It will be a new field which will give us around 15,000 barrels of production. Now, the important part which you said is around the timeline. We expect that, our volume trajectory, will go up from Q2 onwards. We will be at, around 98, 99, in this Q1, and then of course the trajectory goes up, and we have a higher volume during Q3 and Q4 when we start the play of infill wells in, offshore, as well as the benefit of ASP. Again, I think beyond this, some of the few things for us, I think, came beyond the current volume is, what we are doing to grow our volume. And that is more importantly driven by the robust portfolio which we now have on the exploration side. And recently we had said that, we are starting the shale drilling campaign in Rajasthan. So the well gets spud in July of this year. And we'll do 3 wells and we'll get to know how it, works out for us. How are we able to make it economical, and then we'll come out based on the results on the full field implementation. In Northeast, we have got first oil discovery in our OLP block, what we have now named it as Rudra, and we are doing a couple of appraisal wells starting next month, which will then give us volumes later during the year from Northeast as well. The deepwater project is anyway going ahead. We are acquiring data through a CSEM survey. We'll have the results somewhere in July, August, and then we lock in the rigs for next year drilling. So these are some of the key things which will, give us larger volume going forward. But I think in the near term, focus is on managing decline, growing the volume, ensuring that we meet our guidance. The other part, I think, which you asked importantly is, how much volume is being contributed through our, OLP blocks. Currently, it is around, roughly 4%. And I think our now focus is also on larger volumes through the OLP as well as the DSF fields, because towards the EBITDA, they contribute disproportionately much more compared to the volume, they contribute. So I think that is one of the focus areas. So that's all from my side. If you have any questions, you can let me know.
So any indication you will give on OLP proportion? It was 4% in FY25. For FY26, how much can we expect? A broad range will also do.
Correct. So, what we are working on is trying to figure out whether we can reach around, 8 to 10%, by Q4. It will depend upon, our current Jaya producing field. We are drilling a couple of more wells in May. They are more appraisal exploration led. And then Northeast, which I said, we have got the discovery and we are looking to monetize during this year. If both of these work, then it will be, 10%. And the other part, the DSF, which I said, where Ambe we are drilling the well, but it takes time to, since it's a new offshore development, we'll have to, build the platform, connect the pipeline. So it will take 18 months, but I think the objective is to move to that 20-25% in at least 18 to 24 months.
Perfect. Thank you so much, and all the best.
Thank you, Amit.
Thank you. We'll take our next question from the line of Rashi Chopra from Citigroup. Please go ahead.
Thank you. Sorry, these questions might be a bit repetitive because I got my call dropped. But just on the aluminum side, again, just to clarify, so Balco has gotten delayed to the first half, the Balco expansion. Is that correct? From the first quarter?
Anup, you want to take it?
So Rashi, we are still maintaining the guidance of first metal at end of the quarter one. So to that extent, while we said that first half, but we are still maintaining the guidance that by quarter end, June end, we should have the first metal from Balco.
Okay. And then the alumina 3.5 to 5, that is in progress already.
That is correct. Yes, that is correct, Rashi. That is in progress. So the team is currently, they have commissioned the first 1.5 million ton train. And on the second train, we started to commission. In fact, we've had metal from Calsan 4 already. And by the end of this year, we are targeting to be at a run rate closer to 4 million tons. And by next year, we will hit our 5 million ton run rate. So that's how we're looking at our Lanjigar refinery. I think just to also add to the Balco expansion, I also want to give the team credit here, because when we started the project, the team has since actually done continuous improvement on a project model, which again I think is great given all of the expertise that we uniquely have in this field. And we've actually added onto to the capacity, and we've reduced, I think, the specific power consumption by about 2.5% and 3%. And they've also made some changes to the cathode block. So that has caused some delay up front in terms of order placement, and the team is now catching up on that. So that is why we're still holding to the overall timelines, but the comfort for everyone is that we are building a far more improved project in Balco.
Okay, and then just on the coal blocks, again, if you could just kind of give the timelines for all three again, please.
Rashi,
You can take it.
Rashi, I think we have answered this, so good if we connect offline. In the interest of the time, we are already 8 minutes behind the scheduled time. So I think this will be the last question, but I'm happy to connect with you because this was already answered on the call while your call dropped.
Okay, no problem. Then just one, I don't know if this has been answered, but what is the debt repayment at VRL for FY27?
Suggest that you look into the slide. We have given the full details in the deck, year on year.
So maybe I'll take it summarily, Charanjit. So FY, first with 26 current fiscal. So 920 million is the debt repayment due in the current year. Next year, FY27, it's about 675 million. So very clearly, the need for cash at VRL, in fact, is declining rapidly, led by both deleveraging and refinancing. At the same time, overall cash flow at Vedanta India, given the augmented volume, compressed cost is much higher. So overall, we as a group, in terms of cash management, is historical best position.
Got it. Thank you.
Thank you.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I now hand the conference over to Mr. Charanjit Singh for closing comments. Over to you, sir.
Thank you, everyone, for taking out the time to join us. I hope most of the questions were answered. For any unanswered question, feel free to touch base with the IR team. We'll be happy to provide you all the responses and details today itself. So with this, we conclude our call. We look forward to reconnecting with all of you towards July end to discuss our Q1 performance. So good day and goodbye.
Thank you. On behalf of Vedanta Limited, that concludes this conference. We thank you for your participation, and you may now disconnect your lines. Thank you.